I don't understand at all the mentality of Trump, honestly. He's also directed the Department of Defense to start testing nuclear weapons at the same level as China and Russia.
There was a Central Park in Japan. That Central Park was worth more than the entire state of California's land. How often does a dollar change hands? And so credit creation is what creates that velocity of money.
From the year 2000 to 2020, the number of banks in the United States dropped in half again, from approximately 8,000 to about 4,000 banks.
Episode 63 of Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. We've got a lot of stuff that Jeff and I are interested in talking about today. Surprisingly interesting, at least to many of you listening, but certainly to Jeff and I, about banking and some alternate perspectives of how money is lent, how this affects real estate prices, and kind of larger issues that are pretty heady and academic, Jeff. But before we get into that, Sir Fed Chair Jerome Powell has spoken, and we are ordained to live in a world that he has set forth for us over the next 8 weeks. What did you hear from Powell's speech, and how's the market react?
Yeah, you bet, Mark. So it's, in fact, these will actually tie together, this topic with what we'll dive into a little bit. And it may be of interest and heady only to you and I because we're swimming in deep waters here. But top of mind, the Fed Reserve met yesterday and announced the widely anticipated, 0.25% rate cut, to their target Fed funds rate. Reminder, that's just a short-term lending rate. It doesn't automatically impact, interest rates. But a couple of things that were interesting of note, one, there were two dissenting votes on this, ultimate decision to cut the rates by 0.25% or a quarter point. One of those was dissent in favor of a 50% basis point cut. The other was dissent in no cutting at all, which was just interesting. But beyond that, I think one of the most interesting things, and what a lot of people were watching for, is in comments after the meeting, Jerome Powell was basically kind of hedging a little bit, saying, hey, a cut in the December meeting is not a foregone conclusion, and we don't necessarily have it penciled in, was the way I read his comments. I don't think he was saying that they were absolutely not going to cut them, but that the market has generally been expecting, and previously they've signaled two rate cuts this month and then in December, and now he's pumping the brakes pretty meaningfully on that, saying, yeah, that may or may not happen. I think one limiting factor, Mark, is with the government shut down and data sources they're used to having, like BLS data around employment and jobs and inflation data, is not what they're used to having as they're making these decisions. So I think at the same time, they feel like they're flying a little bit blind there.
Boy, yeah, for sure, Jeff. 98, 99% chance that the Fed was going to do what they did. One of the things that came up in their speech and out of the meetings was that a little less certainty around the December rate cuts that the market was expecting with near certainty prior to this week's presentation. I have seen that we're now down to about a 60% expectation of a rate cut at the end of December. Jerome didn't hint one way or another, said we're just not really sure. There's a lot of the data and conflicting data pieces that they're having to look at and assess to decide where they go. The two dissenters, one in either direction, no rate cut and one in a larger rate cut, are there. So there isn't consensus even today as to what should be done. And, I don't know if we're going to have a clearer or less clear picture when they meet here in December. That is the next meeting. We actually had to look that up. I kind of thought they were monthly meetings, Jeff. They are not. They are about every 6 weeks, 8 times a year. So there is no November meeting, and we will be waiting until December for the next cut. One of the curious things here is what Jerome Powell is kind of highlighting as a net zero equilibrium as it relates to the job market. And that is that job losses are really being matched by job creation. And his point was that's kind of an odd reality that we're sort of in this neutral place, given what we consider this to be a very resilient and strong economy. So why aren't we producing more jobs as the economy is sort of booming on a number of fronts? I think that's booming from a macro perspective. We've talked a lot about the micro perspective and anecdotal, sure, including Chipotle last night or 2 nights ago with an earnings release and was down big after a big earnings miss, and the Main Street America just not spending as much. And so we see those all, but still the economy at large from a macro perspective seems to be going really strong. And I think Powell is wondering out loud if AI optimization and efficiency is to blame or credit for some of this.
Yeah, exactly. I see a lot of headlines around that, topic in particular, Mark. In fact, just this morning, I think the Journal had several articles, or at least they have over the last couple of mornings, talking about, either job losses, cuts, or basically a freeze on hiring, even as, some of these large and particularly tech companies, but others as well are looking to expand. Walmart, I think, was one that was highlighted in one of the stories as not going to hire, but expecting to grow with, kind of with current headcount capacities. Mentioned on their earnings call recently. There are a lot of these conflicting trends that are kind of interesting to observe. And does it mean that AI is now taking a bunch of jobs? I don't know. I do think it's leading to some level of productivity, which we've talked, a fair amount about, and the expectation of future productivity gains with existing headcount as opposed to needing to add more. I wish I could remember which company. There was one company that had CEO had said, we're fighting this bias to grow by just increasing headcount and looking to leverage the technology to basically to make our people more productive, which is one of the promises with the AI revolution.
Yeah, it's hard to know. We've watched a pretty vigorous debate between our tech venture capital podcast. They're all buddies. We're not buddies with them, but the buddies there that in the All In podcast talking about it. I think one or two believe pretty strongly that there is a pretty serious reduction in total employment as a result of AI. The other saying, I think that's more correlation, not causation. And so I don't know. And I think it's really not known yet. There are certainly a lot of layoffs at a lot of the big companies. But, I think Elon buying Twitter, what his 2-year anniversary was maybe this week. We can't get through a podcast without me bringing up Elon. Sorry about that. But that really started the P&L in L side, the expense side of the P&L in optimizing these balance sheets. Facebook followed. It sort of gave permission to a lot of folks to do that. And so, we've lived through that. And so could you blame that on AI? Yeah, maybe. But I don't. That's certainly not what Twitter did. That's not what Amazon did and Facebook did at that time. So I think it's still unknown, really, Jeff, as I see it. The last thing that the Fed decided to do, and we talked about this on our last podcast, was they decided to end the balance sheet reduction, the mortgage-backed security balance sheet reduction, right? And so they were at the peak, had $9 trillion of mortgage-backed securities on the United States balance sheet. It's now down to 6.6 trillion, and their plan is to hold and stay at that and let those bonds expire as they do expire. This, as we talked about last week, although to me it's a little bit counterintuitive, this should have a lowering effect of bond prices, 10-year Treasury, which then correlates to mortgage rates. So I think that's some of the reason that we've seen mortgage rates drop from 6.4% to what was 6.13 before the Fed spoke, gave us good news. Now we have rates sitting at 6.35 or something like that, Jeff.
Yeah, I think one of our mutual friends, Tony, has quibbed again that we're back to a place where good news is bad news and bad news is bad news. I mean, no matter what they say, rates had gotten better and they've gone back up even with a bit of a cut. But yeah, my read on it, Mark, is that as the Fed is easing or stopping their quantitative tightening, looking to hold where they're at rather than just let those assets fall off of the balance sheet. They're going to maintain the same level, which is basically has the effect of pumping some more liquidity into the system, which should be favorable, for rates, regardless of what they do with their target interest rate, policy. So, we'll see how it plays out. I think, for me, one of the main takeaways is that a cut in December is not a foregone conclusion. It's not a given. Now, data between now and then will ultimately drive whatever that decision turns out to be. But always interesting when they meet, not just to see what they do, but how they're forecasting or projecting the future as well.
Jeff, I would define from a mortgage application standpoint, people buying and selling homes, refinancing and all, I would describe the theme of this last cycle that we continue to be in is the cycle of the fence sitter and those that are just waiting. That life has happened. They need to make some moves one way or another, whether it's downsize, upsize, relocate, whatever. And they're just not. Yeah. And I don't know. I think the lack of certainty painted by Powell for December meeting is actually maybe a little bit helpful to folks like you and I and the other real estate professionals out there. I don't know what he's going to do. And there isn't some 90+% certainty. It's more like a coin flip. And I don't know what we get after that. So maybe we get a little bit of nudging of mortgage application and fence sitter, movement, I guess, off the fence one way or another.
I think that's a really good point. When there's an almost certainty that rates are going to get better in the future, you don't act unless you absolutely have to. When that certainty is removed and you've already been waiting, why not move now? I think, will be really fun to track the next couple of weeks if it does pull people off of the sidelines or not. And rates are better. I think you shared with me the other day, rates a year ago this time were like at 7 or something. I mean, they were quite a bit higher than they are today. So it's interesting. I saw a trend, or a map that was showing some value or some home price reductions in markets around the country. The combination of better rates, and even if it's not a lot, but a little bit of softening in prices, should all have that effect of pulling people into the markets, which is, what we would love to be seeing happen.
Yeah, and on the subject of certainty, I'm not exactly certain what's come out of the meeting with President Trump and President Xi last night. I know there was one. I know there were a lot of pictures taken. I've seen a few bullet points here and there, but it does sound like we are on the verge of an agreement, a trade agreement. And that has really been the big domino that needs to fall to kind of give everybody the rules of the playing field for 2026 and beyond. And that's been the exact opposite of what this mid-negotiation has given us in 2025. It's just a whole bunch of unknowns, which has been really tough for anybody that interacts overseas to conduct business, and then all of us that feel the downstream effects of that difficulty. So, I think we're heading to a 2026 understanding of the landscape on some level, Jeff, and that is certainly what this White House has said that they are aiming towards. And I think that's nothing but good, leaving the uncertainty.
Yeah, that's exactly right. It's way more likely for business investment when there's a higher level of certainty than uncertainty. So coming out of the meeting with Trump and Xi, a couple of things that just stood out, from what I had seen, and not a lot more than the bullet points I think that you were referencing, but one, an immediate reduction in tariff rates, from the U.S. on China. I think a signal desire to work together, moving forward. They referenced, some bullet points to, start taking action on. We'll see if that happens. Now, of course, I don't understand at all the mentality of Trump. Honestly, he posted at some point in the last little bit that he's also directed the Department of Defense to start testing nuclear weapons at the same level as China and Russia, but then said that had nothing to do with China or the meetings with China. It's like, I don't honestly know exactly what the thought process is there. Interesting. On a side note, not that we're going to make this a nuclear discussion, but I think I had read that the last U.S. testing of nuclear devices was in the early 90s, like 1992 or something like that. So I mean, if they're supposed to be this deterrent, I do kind of hope that, the fuse still works and hasn't gone off on them, I guess. I mean, it was just interesting, to have that little side note right on the heels of this meeting, directly with the other, kind of big superpower.
Yeah, boy. Yeah, nuclear. The wild negotiation. Got no idea. By the way, Jeff, not only is it not the Department of Defense testing nuclear bombs, it is now the Department of War testing nuclear bombs. So that sounds more aggressive to me. So hopefully it's not that. I did, on the subject of, and we're living through this in business and economics generally around the U.S. is at least the perceived role of like business magnates, particularly on the tech side, that are so much a part of our economy these days, and how much influence they have in federal policy these days. And your mention of the nuclear weapons, I had just happened to see that Palmer Luckey, who is a young eccentric dude that that started Anduril, which is building a lot of the modern weapons for the U.S. and people around the world, had just happened to note in some tweet last week or some speech as an aside that he was surprised some marriage advice he had given was the stuff that was making people react, instead of him suggesting that we needed to regain nuclear or restart nuclear testing. So he actually suggested it last week. I hadn't seen it anywhere. And I think there is a dot to connect. And it's just a point that there are a lot of business folks out there that have the ear of this administration, and things are happening because of that, good and bad.
Yeah, 100%. And we talk a lot about these multiple converging streams and just currents in the economy. The Fed meets, Trump and Xi meet, the net effect on whatever the markets perceive and what interest rates do, are kind of weighing all of these factors at once. Just the last note I'll make on the nuclear side is, historically, a lot of that testing was done like literally in my backyard. Like downwinders were a thing where like the wind would literally blow the nuclear fallout like this direction. So I lean on that as an excuse for any missing chromosomes or other deficiencies that I have going forward, Mark. So if I make you look smarter than you are, it may just be my deficiency and not necessarily your innate intelligence.
It all makes sense, Jeff.
I figured that may connect the missing dot for you there.
All right. Well, let's jump into a passion subject for Jeff and I. I got to be honest. I'm really not entirely sure, too naive to understand whether or not this is, or to what degree this is conspiracy theory in economics and banking. But a topic that, Jeff, I told you last week that it was the second time I had listened to this interview. Neither time was I very excited or interested to jump in and listen to the interview. But the second I got into it, I was enthralled. I think you had a similar experience. And this was an interview that Tucker Carlson did with Dr. Richard Werner, who is a world economist out of Germany, did a lot of study in Japan. And, side note, the last thing Jeff and I are intending to do is get overly political on this. I realize that Tucker is a lightning rod for a number of things. I didn't find this interview very political. I would recommend a lot of people go listen to it because it's just really interesting and I think could give some foundational background on real estate prices, movement of real estate prices, how lending works, or at least maybe an alternative theory on it, Jeff. And so all of that, and for those that may not like Tucker, I thought he kind of shut up in most of this, and it was Richard Werner talking for an hour and a half or however long it was. So we'll link it in the show notes. Jeff, what did you think of the podcast? Tell us what it's about, or the interview. Tell us what it's about. Get us kicked off at the top.
Yeah, you bet, Mark. It really was, and it's funny to hear you describe. I wasn't really excited to hit play on the podcast, and what you do is like, oh crap, this is really interesting. I had kind of a similar experience. Went back and re-listened to it to try to understand, and I'll just affirm also what you said, that I was almost a little bit surprised, that Tucker probably spoke, 20% of the time, or I don't know what, but not very much. Just letting Werner talk through, a number of different things, but it was really interesting. And I think, we may be able to do a little bit of follow-up beyond this to try to dive into, how much credibility is there really. But the thing that, a couple of things that I found so interesting is that, in a nutshell, and we'll see if I can do this, justice or not. So Werner's theory, I guess there's a lot, that went into it. But one of the things that stood out was really interesting is, he's basically saying, hey, traditionally we think of banks, and especially in economic models, we think of banks as either an intermediary, which means they just transfer money from one group to another. They don't really impact the economy or money supply. Another theory, economic theory around banking is this fractional reserve aspect that says, they do loan money beyond just the funds that they have available in an account. So it's not just that Mark deposits $100 in the bank. I come to the bank asking for a loan and get that $100 that Mark put in. They basically, will lend some fraction beyond that. So they have some impact on expanding credit or money supply. Werner's kind of theory, which he titles credit creation theory, talks about banks extending credit to borrowers in a way that isn't necessarily tied to deposits. It's out of nothing. I can't remember the Latin term that they referenced in the podcast, but basically a term meaning that it was issued out of nothing. They just create the credit without necessarily any corresponding deposit in the bank. And so it was just really interesting to dive in and try to understand a little bit better, how does this system work financially and regarding the banks. Because one of the main points he makes is that most, if not all, of the macroeconomic models and projections, banking is kind of set aside. It's not considered to have a material impact in gross domestic product, in like the financial market. It's just an intermediary. And he's saying, I don't think that's right. I think that they impact significantly the supply of money and the investment, that takes place. So probably the highlight, takeaway for me was centered around those aspects. They actually cover a lot of ground on, numerous different topics, Mark, and we'll get into a few of those others. But tell me where I've told lies about it and what else, may have stood out to you.
Well, ex nihilo, I think, is I don't know if that's Latin or Jeff, I don't remember what it is. I'm way off there, but out of nothing is essentially what that means. So a couple of points that I'd like to make and that I think is helpful in setting up the discussion is that this credit creation theory came out of, so he was like one of the few or first non-Japanese economists to kind of go to Japan and study the economy. And this was in the early 90s and late 80s at a time where the Japanese economy was booming. And it created a whole bunch of things, and it ultimately crashed. He sort of thought that it would, but there was an enormous real estate bubble. There was a Central Park in Japan, in Japan. Not even sure which city it was. I think Tokyo, but that Central Park was worth more than the entire state of California's land at some point in the early 90s. It was sort of ridiculous. And it's not the first time that this sort of thing has happened when an economy booms the way that Japan was booming. And in the same way that these sort of series of events took place, they took place in a lot of countries with booms like this, that no outsiders were buying any of the Japanese land, but it was skyrocketing, and it was changing hands, hand over fist, and frequently. And so there was just this inexplainable rationale as to why that's happening. And many others had, I think Sachs is the name of one that Jeremy Sachs is it, I think. I don't know if I got his first name right. Okay. But he had tackled the subject and said, there is no correlation between whatever hypothesis was put out. So there's a lot of people doing studies on why the land had gone up so much. And ultimately, Werner studied and landed on this credit creation theory, which is that when banks are lending for real estate speculation, that it is thought that banks are just an intermediary. And Jeff, you had mentioned that in GDP calculations and analyses, banks aren't any part of that analysis anywhere. And it is just thought and sort of written off that banks are an intermediary. And they are, and so because they are just a money in and same money out, there just is no impact on the economy one way or another. And so that has been where every economist has landed. And it's kind of developed this axiom that is that this thing that everyone assumes is true, but nobody's really tested, that banks are just sort of not necessary to analyze economies and markets one way or another. And so, longer story than I want, but he ended up theorizing that when banks, everyone thinks about a central bank, like the US central bank, European central bank, that they create money out of nowhere. They print money, right? And that's pretty obvious. Everyone does that. But when banks these days are actually lending, that there is no withdrawal from another account to pay out that borrower, that it is creating money, essentially. It is the credit creation theory here. And to prove it, he went into a bank or two and took out a loan and worked with them to understand exactly what the journal entries were. And so, I think one simple way to think about it is that if I deposit $1,000 in a bank, they might need to keep 10% of that money. So they lend out $900. Well, that money, $900 lent out, goes into another account that bank holds. They keep 10% of that, and now they lend out $810. Well, the next thing, they keep 10% of that, and now they lend out $730. So that same $1,000 lend is done over and over and over and becomes $10,000 ultimately of loans lended out. And so this is just created money. And when it's done in real estate speculation and consumer credit or consumer loans, that it's really ultimately bad for the economy, and ultimately a Ponzi scheme, is he would say, that runs out when ultimately that country needs to stop, hold back the credit, I guess, Jeff. So I'll take a breath, take a pause there. Fascinating topics to me, maybe because it just sort of resonates with how, intuitively. So what do you think? Where are we?
Yeah, absolutely, Mark. So, and I think your description of, taking the $1,000, depositing, and then, this cascading effect is exactly what he was describing in this real estate value bubble that Japan went through, because that's what was happening. He makes the point that no outsiders were coming in and buying, the Japanese real estate, but it was turning over internally through this bank credit, and basically monetary expansion, kind of Ponzi scheme. I think it works until the credit creation dries up, and at some point you run out of the ability to just add more money, because you've taken that $1,000 and extended it out to the the $10,000 mark or whatever. And just really, really interesting that it cascaded as far as it did. But as I think about the run up in real estate, more recently, leading up to the great financial crisis in 2008. I remember talking to a kind of a speculator developer who had walked into a bank that was relatively new in the area, thinking about it through this lens. It seems like, yeah, that's probably exactly what they were doing, was extending as much credit as they could possibly justify. This guy walked out of the bank with a $1 million personal loan that was unsecured, unsecured in terms of assets. And he was going to, speculate on lots or development land or something. Well, you fast forward a couple of years and that bank, runs out of the ability to extend credit, goes bust. I mean, it gets taken over by the FDIC, and whatever assets it held were sold for pennies on the dollar. And it was just kind of a microcosm of what Werner was describing as having taken place throughout the entire, economy in Japan. It just expands to the point that it almost eats itself. And one of the points he makes, Mark, and maybe we can talk a little bit about this, is that credit creation or basically lending by banks for certain functions within the economy are productive, and for other functions within the economy, they're not productive. Lending money for asset purchases, and especially real estate, that doesn't produce of itself anything. Now you need real estate as part of the inputs, to house the warehouse or the storefront or whatever. But just because that asset price goes up doesn't mean that there's more goods or services, physically being put into the economy. So one of the interesting points that he made was that when lending is done like that, like in Japan in the early 90s, when it's just enforcing an asset bubble or just to buy assets that aren't productive, it doesn't lead to any GDP. It doesn't lead to anything meaningful coming out of the economy. But when it's invested in businesses that are directly injecting goods and services into the economy, that's a productive use of bank lending and credit extension or credit creation in a way that has a positive net effect. And he even argues that keeps inflation down because it's injecting the quantity of goods and services into the economy. It's not just adding more money to pay more money for an existing pool of goods and services. They're really interesting connections, but that was also a point that really stood out to me.
Yeah, it stood out to me too, Jeff. It is really a fascinating listen on a whole number of fronts. It resonates with and I think correlates to this enormous bubble that we've lived through over the last 5 years. It is the central bank printing money in this case, which is what I assume happens and clearly did happen here, But I think there's a compounding effect with this credit creation theory of just massive amounts of credit being put into the marketplace to speculate one way or another, hoping that someone will speculate a little higher than you down the road. I don't know. It explains a lot, and there's a lot of theories that are. It's not grating. I think it's challenging to the world that we live in as real estate professionals, and that was why I thought our listeners might, while very heady, might find that podcast or our summary of it interesting, because it challenges a lot of the knowns in our space. One of those, from a macro perspective, one of his principal arguments is that interest rates don't really move economies up or down, whatever direction. It is the velocity of money, M1, M2. We talked about that a little bit. It's just how often does a dollar change hands? And so credit creation is what creates that velocity of money. And I think he is the father of the term quantitative easing, if Wikipedia is correct. And I think implores central banks to use those strategies to manage economies one way or another. Not always done well, but I think he's thought the United States has done it well. So the last thing I'll say, Jeff, is in turn some interesting topics over to you that you found here was, describing, I think from the ancient, I think this was in his podcast. There was also one from Aaron Sorkin. He's written a book on the Great Depression also, Jeff, which we should talk about at some point, but it was kind of how we got into the banking problems that we got into. And I heard an interview with him. But was just talking about how this, people essentially held their gold at a jeweler or a goldsmith back in the day, and that was kind of wealth. And so if I needed my gold to go do something, but everybody stored it at the safe place at the goldsmith, but if I needed that gold to go buy something, this is where the loan's like, well, hey, here's your gold, but I mean, it's kind of heavy. You can bring it around everywhere. I can just give you a piece of paper that says that you have the gold. Why don't you just deposit in a second account that I've got, and then you'll have a piece of paper that says that I've got it. And so it's like not having to move the money one way or another, but there's a little bit of a magic wand through accounting that happens there, because the money didn't move at all, but the lending took place, and there's a promissory note out there as such. So I don't know. Really, really interesting lesson.
Yeah, the story around, kind of this evolution of banking, starting with the goldsmiths as basically the custodians of the store of value, and then, realizing, well, we can just issue certificates of deposit, basically, which, means, I've actually got the asset here, and then those become what's tradable, which leads into, kind of this theory of money in general. He described it really well. In fact, there's a funny part where Tucker says, "Are you sure you're even an economist? You're describing this so well. I can actually understand it." Kind of, jabbing at most economists that don't explain things very well, or in ways that make sense to the layperson. I think the last point on that, Mark, that was just interesting is he also talks a little bit about a story of China and Japan, where a Chinese leader came to the Japanese and was essentially asking them, for perspective or advice on improving their economic outlook because they have such a massive population. And the takeaway was that China at the time had a central bank that was centralized in all of the banking decisions. And the key insight was that you can have, a handful or however many, central bankers trying to, make credit lending decisions for a population of hundreds of millions, or you can institute a whole bunch of small local and regional banks that have a whole bunch of loan officers and multiply that, by thousands or hundreds of thousands of people involved at the local level, making credit lending decisions that can have, on net a way more leveraged, way more effective impact on just extending credit to businesses and to individuals that will do something productive with that. One of the things that he talked about, and that I've observed, naturally happen, is banks have a tendency to want to merge and come together. And the bigger the bank gets, the bigger the deals are that they want to go after. And big banks want to do big deals with large profit, margins or abilities. One of the things that Werner argues is that, smaller, way more distributed banking system leads to greater prosperity across the country for everyone, because small businesses, individuals can get better access to credit when you've got a whole bunch of community banks as opposed to a very limited number of very large banks that are primarily incentivized to do big deals and not small business and individual level deals. That made sense to me. One of the things I've observed is a discussion or just these headlines around, wealth being concentrated within a increasingly smaller number of people in the country. And I wanted to just share this real quick to highlight that, that potential correlation. And honestly, there's more to learn here. So I don't know. I'm not going to tell you that I know this is causal necessarily, but it was really interesting. I did a quick search to see how many banks there were in the United States over time. And this is what Grok is telling me. It looked like it was accurate, but I haven't, proven this at a PhD level yet or anything. But in 1921, they're showing approximately 30,000 banks in the United States, which dropped down in half to just under 15,000 going through the Great Depression in 1934. So as you talked about, Mark, Andrew Ross Sorkin is the guy that wrote that book that about the Great Depression that we'll have to dive into on a future pet passion project or something. But Great Depression wiped out half of the banks in the United States, or thereabouts. From 34 to 1988, held kind of stable, and then through the late 80s into 2000 dropped from 14,000 down to under 10,000. What was interesting that stood out to me was through the great financial crisis from the year 2000 to 2020, the number of banks in the United States dropped in half again, from approximately 8,000 to about 4,000 banks, going through that pain. But a massive trend downward, and I think a trend of consolidation of banking in the United States. And that's not to say that every community bank and local lending institution is gone, but there's certainly far fewer than there used to be. And it's just interesting to see this trend juxtaposed against this narrative of the rich getting richer, but the average person not necessarily getting any better off. I don't know that I subscribe to the fact that the only way to produce wealth is through leverage and borrowing, but I think it certainly is a meaningful input for many businesses and individuals trying to get started and off the ground. So just an interesting trend I wanted to comment on before we move on.
Boy, it definitely is. The consolidation for sure you can feel here happening. It feels like that is the desire and intention with these mega banks that are in play here. Yeah, just really good stuff, Jeff. I think maybe a core takeaway from me from the discussion is, and I think this is kind of appropriate to appraisers and real estate folks indirectly with what they do here. And it's that the quantity of money is much more important than the price of anything. It's just how, and boy, do I think we lived through that over the last 6 years, that and really last 25 years, coming out of the great financial crisis. And so if the quantity of money is more important than the price, and we know that not just it's possible that not just central banks are creating money, but also bank lending is creating money one way or another, then I don't know. It's one way to assess how much money will be available, to kind of support prices moving forward. I don't know if that's if that resonates with you, Jeff. I'm not sure if I said that cleanly, but that's a takeaway for me.
Yeah, I think it does, Mark. And there were a number of takeaways. In fact, I found myself listening to this, jotting notes wherever I was, in the gym, like stopping to make a few notes just to try to understand better. And, we've named this podcast kind of intentionally for a reason. And I think you and I are both fascinated with how markets work, the market for money, the market for credit. It has been really fun to dive into and try to understand a little bit better. This is really for me kind of a journey of trying to understand and learn better about how the world works around me and within the markets in which I participate. And so this definitely was a fascinating listen. I think we'll probably have some more learning come out of it, maybe a follow-up episode at some point. But a lot of fun to dive into. I'm glad you found it and shot it over to me, even though I ignored my wife and kids a little bit watching part of the World Series game last night, so I could make sure I was up to date on what we were going to talk about today. But I did catch the outcome, by the way.
I will say, Jeff, that we did not emphasize this in our summary coverage of the episode, but there is a lot of fun conspiracy stuff there. I think this power to create money, as you might imagine, is transformational if it exists in the way that Richard thinks he's proved. By the way, Richard Werner is sort of what I can tell is maybe the Graham Hancock of banking. Graham Hancock in the archaeology world is sort of trying to prove that there were humans on this planet well before archaeologists assume there are, and so nobody likes him. Everybody thinks he's a quack and a kook, and I think that Werner may fall into that. I think he's pretty critical of economics generally. Why on earth are you not considering banks in any of your economic analysis? But that familiar names like Ben Bernanke and many others started out their careers being in favor of credit creation theory and slowly moved as they gained prominence to this fractional reserve theory. And, so there's a lot of conspiracy thought mixed into it as well, Jeff, that I thought was pretty interesting and had some legs.
Yeah, the conspiracy resonates with you a little bit, Mark. I know. But I like that it just causes you to think, is the status quo that I assume to be, correct? Is it really? Is that really what's happening? And is it what I actually observe, when I go in to get a home equity line of credit or something? Or does it maybe happen more along the lines of what's being described here? And my guess is that the truth probably falls somewhere in between. Maybe not. Maybe he's totally onto it. But it caused me to think, which I definitely appreciated as much as anything. So a lot to try to unpack and understand. The financial system is just so complex, even in of itself. It definitely gave some insights into how things work from banking perspective, monetary perspective. And I don't know. I'm not endorsing that everything he says is correct and accurate, because there are certainly those that have opposing theories and views from what he expresses. But it was interesting. It was fun to dive into for that reason.
Jeff, it's this. I think my interest and curiosities peak on the discoveries of these axioms or discussions of them. For me, they're discoveries because I've never thought of them. But for those that aren't fully familiar with that axiom, it's a fundamental principle or rule that is assumed to be true without demonstration, serving as the starting point for further reasoning and arguments. And when a suggestion that one of those axioms might not be true, it's just, oh wow, yeah, that's interesting to think about. And I think my curiosity tends to peak when we run into some things like that.
Absolutely, and he tackled a few of those in this interview, and I'm with you, Mark. It's so easy to just take for granted whatever the known is, and then we start to question a little bit and wonder, man, maybe is there something here that we haven't, thought about? It really can lead to some key and critical insights. So it was a fun conversation, for that reason, among others.
Be great to have a few listeners come along with this kind of study that we're doing with this, and maybe we'll talk about it a little bit further in the future. But check out the link to the actual interview. Hope you enjoy it.
Yeah. Yep, absolutely. One last thing, Mark, and then we'll probably jump. I did see a note around home builders calling on the Trump administration, or at least, kind of singing along the same chorus as the Trump administration, for an easier way to provide additional housing units in the economy. They're saying, hey, Trump administration, you're asking for us to build more homes. Why don't you have Fannie and Freddie make construction lending available to us directly? It was an interesting, evolution. We've been commenting on and following pretty closely Fannie and Freddie and conservatorship, and when and if and how they're going to be released and all those sorts of things. This was just an additional interesting dynamic of, does straight new construction financing get injected into something that they are doing? It's more risky. I saw, some dissent or concern around that idea, saying it's a riskier pool of lending than what they've been doing, and they're probably not capitalized to absorb that risk yet. But it was an interesting headline I just wanted to comment on as we close out, Mark.
Yeah, fascinating. I think they need ideas if they're going to figure out how to boost construction of homes. Interest rates where they are, prices where they are, costs where they aren't conducive right now. So I think some creative thoughts like that and listening to the builders and what they need is one way to get there. Well, yeah, Jeff, I'm watching Google 2 days ago up 7 or 8% after hours after having a great earnings beat. I'm watching Chipotle down 16%. This is the haves and have-nots right now in this economy we've been talking a lot about. It is indeed interesting times.
It is. Maybe we're onto something with this consolidation of banks and credit creation. Maybe we're just as kooky as anybody else out there, but fun to track, and appreciate the conversation, Mark.
Till next time, Jeff.